Welcome to the B.F. Anderson Technical Report for September the 16th. You know, the Federal Reserve is, of course, an important institution. Janet Yellen is our chairman. They have a very difficult situation right now. The situation is this: the GDP growth rate worldwide is incredibly slow. We've had the worst recession since the Great Depression back in 2008, 2009, and the growth rate coming out of this recession has been anemic at best. However, the Federal Reserve's one of their primary objectives is to maintain low inflation or reasonable inflation. Inflation is caused primarily by labor rates. Back in the 70s when the unions had tremendous power, labor rates were going up dramatically. Now that really all started after World War II when we had massive expansions of the U.S. economy and things just got too hot. And as a result, labor rates went up dramatically and we had hyperinflation. This is different. We're now in a situation of where the Fed is worried about deflation. Things are too slow. So what the markets are worried about here is if the Fed raises rates, will this cause us to fall back into recession? Well, let's take a look at something real quick here. And let's just kind of get a little bit of a look at the market itself. And let's see if the market can give us some ideas about this, because the thing to understand about the Federal Reserve, they set rates, primarily the discount rate. They also do things like quantitative easing, but they set rates for banks. And this is basically a man-made rate, whereas I tend to lean towards free market rates. In other words, watching the bond market is a way to determine what is truly going on here, because the Fed may be wrong, they may be right, but usually the market accurately discounts the future. The market is very efficient. We just have to accept that fact. So the first graph we've got up here is the NASDAQ. Now, if you'll notice here about the NASDAQ, it really came down during the Brexit situation, which was a major shakeout. You had another major shakeout back here at the beginning of the year. But all of a sudden, the NASDAQ is holding its moving average here. Now, this is the 50-day moving average, which we've talked about moving averages. This is very important because what a moving average does, it takes out the noise. You don't get all these wiggles. So we've got a nice uptrending 50-day moving average. The 25-day moving average rolled over as we got this correction that was driven by the fact that, well, really two things. One, it all started with the nuclear test in North Korea, and then also there was some Fed talk out there where there's concern about higher interest rates. But the NASDAQ popped right back and got right back above the 25-day. Now, the thing to realize about the NASDAQ, this is really a very good index because it's very broad. You've got about 5,000 stocks in this index. I think the NASDAQ truly reflects what's going on because, number one, you got so many stocks, but also this is more to do with earnings. You see, one thing to realize is with the market is it's driven by two things. There's really two strategies out there. One is a strategy based on interest rates, and there's a strategy based on corporate earnings. A true bull market, is driven by higher corporate earnings where shareholder equities are going up. Now, what's been happening in the last, say, 10 years, since 2009, so that's not 10, more like 8 years, the market's been driven by lower interest rates. So if the bond market's outperforming the stock market, utility stocks are outperforming everything else. The utilities are the number one performing group last year and this year. Now, how do you build a future of a country on that? So the fact that the NASDAQ is holding and that is such a growthy index tells me that there's a possibility here that we're starting to see an earnings cycle, or what I call a growth stock cycle, which is a true bull market and one that we would benefit from with our strategy greatly. Now, here's another index. Let's look at 5 indexes. This is the mid-cap index. Now, this is not. Now, you also have to realize, too, on what's going on with the NASDAQ is we have seen orders for the new iPhone have been outstanding. And so Apple is a big component in here, but also it's driving up all the semiconductor stocks, which is really causing this to happen. Now, look, every bull market that I've experienced in every decade, the 70s was mainframe computers, the 80s were personal computers, the 90s were the internet, 2000s was the mobile phone. Now what? Well, I believe it's going to be cloud computing, and that's changing everything. I mean, it's making us more mobile. You have mobile devices now, iPads, iPhones, cellular phones that can do things that computers used to do. Now you can just get on a server in the clouds and do remarkable things with these applications, these apps. So we're getting, I think that there's a possibility that the second half of this decade is going to be led by cloud computing technology stocks and the companies that are benefiting from it. Now, back to the S&P 400 mid caps. These are middle-sized companies. You can see it broke the 50-day moving average and really hasn't recovered yet. So this is a yellow flag. This is not good. Here's the New York Composite. This is every stock that trades on the New York Stock Exchange. Again, broke the moving average, has not recovered. Need to be cautious on those stocks. Here are the small caps, the real small companies. Now, actually, if you notice here, like on the New York Composite, you got a lot of white space here, all right? Well, with the small caps, again, another growthy group, a more earnings-driven group, you don't have as much white space between that 50-day moving average. So, in a way, the small caps are holding up the best along with the NASDAQ. Now, here's the S&P 500, which is 500 stocks, pretty good index, good one to keep an eye on. A little bit of white space in here, but I'm just, telling you that this shakeout that we're getting here, you should be kind of cautious right now. Now, on a longer term basis, here's another moving average we look at. This is the 10-month moving average versus the 20-month moving average. We look for what we call golden crosses, and we also look for things called death crosses. Well, as you can see right here, right now, we are still in a good long-term uptrend on the S&P. We're trying to make a golden cross. Let's just see if it happens. That's what we're looking for. Now, back to interest rates. Let's talk about interest rates. This is the key to what's going on right now. Now, I keep a very close eye on the 10-year Treasury note. And as you can see here, over the last, period of time here that I've got marked here, now this goes back to the beginning of the year, interest rates have dropped dramatically. Okay, now this was, the low that it made during Brexit. But all of a sudden here, we're starting to see the 10-year Treasury starting to move up. So back to the Federal Reserve. If the Federal Reserve is concerned, or if the market is concerned, that if the Federal Reserve raises interest rates, we go back into recession. I believe the Federal Reserve knows what they're doing, and I do believe that this breakout in the 10-year yield is meaningful. Now, this may just stall out and fall back down again, and shoot, we got down to 1.3%. Now, if you go back to the 1600s, interest rates on the 10-year paper, interest rates tend to always stay between 5 and 10%. That's the norm. Well, my gosh, we're down here to 1.3%. This is a lower yield than the Great Depression. This is a lower yield than the Civil War. We have never seen interest rates this low. In Europe and in Asia, they've got negative interest rates. So this is something that's going to change. Alan Greenspan is a former Fed chairman, has said throughout time, interest rates have always gravitated to 5 to 10%, and he said this is not going to last. We're probably going to go back to 5 to 10%. It's not a question of if, it's a question of when. So I'm just letting you know that interest rates are moving up and confirming the fact that there may be an increase by the Federal Reserve. Now, here's another one I keep an eye on, and if you noticed yesterday, we kind of broke down a little bit. This is the 2-year Treasury note, which is a little bit more volatile, but it's important to see that interest rate is also in an uptrend, but we're starting to get into a little bit of choppiness in here. Let's just see if this holds. All right, now here's another one. Here's the 30-year U.S. Treasury bond. Okay, coming all the way down here to under 2%. Built a base, now breaking out. All I can say is that there's a change. This is a noticeable change, and it should be noted. Now let's look at some stocks. This is Alibaba. This is the Amazon of China. Hit an all-time new high yesterday during very difficult markets, and also China. So if China picks up, who knows? I mean, we could see a dramatic increase in everything. In other words, we could see the economy really start to pick up steam here if China picks up, or Asia picks up, or Europe picks up. But I'm not too confident about Europe. But I do think the fact that Alibaba stock is really setting the pace here and looking very, very good. Now let's look at something that looks bad. This is Dollar Tree. These are all these, the thing to realize here, what's been going on is, because interest rates are so low, and the masses, by the way, the masses are always wrong, the masses are gravitating all their dollars into fixed income, bonds, dividend-paying stocks, Procter & Gamble, toothpaste, soap, tobacco, defensive retailers that sell things for $1, that kind of thing. Well, these stocks are all breaking down. So while the NASDAQ, which is technology-based, is breaking out to the upside, you've got these defensive-type stocks breaking out to the downside. I think there's a change coming. Now, here's a company that we're in that I think is really looking good, is Facebook. I mean, if you look at the projected numbers on this company, it's just unbelievable that this company is projected to grow at the rate that they're talking about. But it's all about e-commerce. It's all about people going mobile. It's all about cloud computing. And so with Facebook, you've got a nice uptrend here above the 25-day, above the 50-day. The 50-day is moving up. I like this stock. Here's Grubhub. Now, this is an interesting company. Now, all of you out there have heard of Uber. Uber is an interesting deal because you can, instead of hailing a cab like the old days, you get on your iPhone and you hail an Uber car, and it comes to you. There's a map on there, and you can see the car coming to you, and your credit card information's all in there. You don't have to worry about giving a tip to the driver. It's clean, better, more productive. Well, Grubhub is basically the same thing, but it's for delivery of foods from restaurants. It's a delivery service. And it's an interesting business plan. And if you look at the stock, it is really holding up in here above that 25-day. Now, I want to show you one more stock that's on the defensive side. This is Coca-Cola. Okay, you have to realize, going back 2 years, this has really been one of the best performing stocks out there. But if you look at the projected numbers on this thing, it's anemic at best, okay? So we're seeing a top, a lower top, and now a lower top, and then we're breaking down below those lows. I think, again, there's a change coming. Now, one last point about interest rates. This is a 20-year bond fund, okay, U.S. Treasury bond fund. Again, bonds have been outperforming stocks. This has been very frustrating for growth guys like me, but we just have to stick with our plan, because the plan is we're looking for growth of earnings. And if the growth of earnings strategy has been in a bear market for the last 2 years. I mean, a lot of people would argue with me about that. But look, energy stocks are down 50%, biotechnology is down 40%, financials are down 25%, and small cap and mid cap growth companies are down about 25% also over the last 2 years. So in the meantime, all the money's been going into this kind of stuff. Well, here we got a big top looking here, and now a breakdown. So basically, in conclusion, what I'm saying is there are two factors out there that you really need to focus on, and that is interest rates and earnings. And the market will flip back and forth on these particular macroeconomic events. So as interest rates go up, that means the economy is picking up, and we're starting to see credit demand, and that's good. And so if we start to see the GDP start to pick up, and there's another index we should keep an eye on, and I failed to do it, and I'll do it next week. We need to really take a look at the transports, because that has a lot to do with economic activity. But I can just tell you, it does look like to me that there's a shift taking place here, so just kind of be aware of it. Thank you very much. Have a great weekend.